Buffett keeps selling shares of Bank of America and has billions of dollars in his treasury chest. Is there something we need to be concerned about with the amount of selling Buffett is doing and the amount of treasuries he is buying? Then we take a look at what Michael Burry is doing as well. Pretty interesting setup for him. Welcome in everybody to Compounding Capital. My name is Colton. We work on fundamental analysis on this channel. And guys, we hit a milestone of 5,000 subscribers. Thank you all so much for the love and support. In today's video, I want to look at what Burry is currently doing. And I also want to take a look at the valuation of the S&P 500. By the way, if you're new to the channel, welcome in, consider subscribing, and I do have a free gift for you if you watch my last night's live stream. So make sure you watch that live stream and you know what to do if you watch the live stream. Now, Michael Burry, the head manager of Scion Asset Management, recently sold out of 11 different positions. And right here are some of the positions that Burry recently sold out of. He sold out of Citigroup, Cigna, First Solar, and BP, to kind of highlight a few here. And we all know Buffett has sold a substantial amount of Bank of America, and he's been buying treasuries like none other, which is making me wonder, what is he so concerned about and why is cash so important for him? I think we'll figure that out as we go further in this video. Now, Burry is really going heavy into the Chinese market here, making Alibaba his largest position. And to be honest, most of China has been on a substantial tear when we look at the stimulus package recently passed by China. Hard to tell if this is really a trade or if this is going to be a long-term trend. Now, Bob is a position we've called out many times to possibly look at taking a small risk on because of the political tension that's involved with owning Chinese stocks, but it was really interesting between that $60 and $70 range. This move by Burry makes Baba a 21% holding in his portfolio, Shift Payment a 14% holding in his portfolio, Molina Healthcare 13.9%, Baidu 12.4%, JD 12.3%. So when we think about that, he is really riding this Chinese stimulus wave, and it seems like he got in at the right time. But let's talk more about what's going on here. We have Buffett selling out of United States stocks, buying treasuries. We have Burry buying Chinese stocks. Is there a silver lining in between that's kind of giving us a warning signal here? Now, if you've been following the channel, I do believe we are hitting a topping process in this market. I don't think there's that much upside, and I tend to think that there's a little bit more downside risk in this market over the next few months than there is upside. With that being said, I do believe the market will make new highs, but I want to break this down to where is the S&P 500 truly trading at, because I think this is why both these investors are making these moves. As of October 5th, we see here that the S&P 500, Morgan Stanley anticipates, should be earning around $269 in 2025 and pushing almost $300 in 2026. As the market is starting to get more and more expensive, we're starting to see people really raise the EPS on the S&P 500 for 2025. My largest concern with all of this is the fact that the labor market is not really well diversified. The majority of our labor market is now really reliant on the service industry carrying the back of this labor market. But the problem with that is we all know the consumer's running out of money, credit card debt is piling up, and we're starting to see car repossessions. Burry snagged 30,000 additional shares of BABA at 2008 levels, along with credit card delinquencies picking up as well. We are also starting to see a shift that consumer sentiment is still pretty weak here. Those combinations tell me that 2025 earnings, if we don't have a strong consumer, I don't think we're hitting these numbers. The forward 12-month PE ratio for the S&P 500 is sitting at 21 times, which is pretty historically high here. But if we look at the 5-year average, we're looking at 19.5, and if we look at the 10-year average, we're looking at 18, and apply it by projected earnings, and then take the 10-year average and multiply it by projected earnings and see where we stand when we look at valuations. So if we take that 269 of projected earnings and we multiply it by the 5-year average of 19.5 times forward earnings, we're looking at an S&P 500 that should be sitting closer to 5,200. Now, if we take the 10-year average of the S&P 500, multiply it by $269 worth of earnings, and the 10-year average was sitting at 18 times, we're looking at a 4,800 S&P, which is telling us that even if we have a perfect earnings estimate going into 2025, and I don't think that's the case, I actually think estimates are a little high. We could be looking at an S&P 500 between 4,800 to 5,200. So when we see the S&P 500 or the SPY trading at 572, and we know right around 480 to about 510 probably makes the most amount of sense, and hence why Buffett may be looking at treasuries and why Burry might be looking at China. Even the Buffett indicator is saying that we are strongly overvalued, sitting at 209%, which is actually 67% above normal trend. If we look at the historical average of S&P 500, it should be just under 20 times earnings. Anywhere between 19.5 to right around 19 times earnings seems to be a healthy trailing PE for the S&P 500 over the last 65, 70 years. And here we are trading at over 28 times earnings. We're actually pushing 29 times earnings currently. Now, markets can remain irrational longer than you can remain solvent, and this is definitely not a market I would try to short. But this would be a market I would be taking profits in or looking to build cash. I probably personally wouldn't be putting any new money into this market. Normally, when you're offsides this much and you have valuations as elevated as they are, the correction could be pretty severe going forward. Now, the one thing I do want to point out with the VIX is we are starting to see it break out here. The VIX is coming alive, and it's definitely going to be a pretty volatile market from everything that I can see. Now, we've watched oil prices start to peak up once again as there is some tension here in the Middle East, and this would be inflationary on top of the jobs data that we got and a Fed cutting into a very strong labor market. In my opinion, all these things are actually inflationary type items that's taking place, and I believe that's why we saw the 10-year Treasury actually tick up. We watched the 10-year Treasury spike on that strong labor market, and to me, I still believe with the Fed cutting into a very strong labor market, oil supply looking to be pretty interesting with the Middle East tension here, there are multiple candidates that could cause a spike in inflation once again, and I tend to think that this battle on inflation is not over quite yet. And when we look at valuations on the market's been so focused on a Fed cutting that the valuation has actually gotten out of hand. We're starting to see people like Buffett and Burry make different moves, more contrarian type moves. As Wall Street keeps telling us to buy the rip because we're in a new bull market, we're watching sophisticated investors like Buffett and Burry do the complete opposite. Now, even though I am in the camp of a harder landing, but it's not going to show itself until the end of next year, I believe things will start taking place in the summer of next year, but we will get a confirmed recession by the end of next year, into the end of 2025 and the beginning of 2026, but we will all start feeling the pain by the summer of 2025, in my personal opinion. That being said, I can't time recessions. What I can do is run analysis, and I can tell you right now that every day that the market gets higher and higher and higher, becoming very difficult to find individual stock opportunities within the market. We have a market trading at nearly 29 times earnings. Yes, there are some deals in the market, but they're few and far between. At some point in time, we have to do a risk analysis here. At what point in time is the downside risk starting to outweigh the upside gain? Now, I'm not saying 4% is exciting, but if we get 4.5% once again, and we're looking at a market trading at 29 times earnings, and the downside risk could be 30 to 40% downside risk, with 2 land wars going on, a presidential election, then at some point in time, we do have to look at that risk-free yield and understand that that might be the best play for right now. Maybe there's another 4 or 5% move in this market, but I also think there's a 25 to 35% downside move in this market. And so at this point in time, my main focus is building a watch list of quality, undervalued stocks that have good balance sheets, good management, and strong earnings. It's a main reason why I brought up companies like Bristol Myers Squibb that was getting extremely cheap, around $40 a share, and was paying over a 5% dividend at those levels. I think you can look at consumer staples. I think you can even look at the gold miners as an interesting opportunity. And in the next video, we're going to break down some individual stocks that I think are starting to present some pretty awesome opportunities. As always, guys, appreciate your time. We will see you in the next one.